Hello and welcome back to the Technical Analysis Masterclass, Trading Indicators. In this section, we will look at how to use and interpret Bollinger Bands. We will look at the different ways that you can use the Bollinger Bands indicator, as well as identifying the market conditions that it works best in. In this lesson, you'll learn how to interpret the different Bollinger Band deviations. You will learn the rules for trading the Bollinger Bands indicator. We will learn how to use Bollinger Bands during extreme moves. And finally, we will learn how to interpret and trade Bollinger Band divergence. The Bollinger Bands indicator is a volatility-based indicator that has bands above and below a moving average. The indicator is based on standard deviation, which expands and contracts as volatility increases and decreases. Bollinger Bands can be used on any time frame and are a highly dynamic indicator, widening when volatility increases and narrowing when the volatility reduces. The standard settings on most platforms use a 20-period simple moving average, with the bands on each side set at 2 standard deviations. 2 standard deviations are used because if the price action is close to or greater than 2 standard deviations, the price action is trading within either the bottom or top 5% of its price range for the time period. This may suggest an upcoming reversal or potentially a significant change in price dynamics. Now let's look at how the Bollinger Bands are calculated for standard platform settings. As I mentioned earlier, the middle band is generally set at a 20-period simple moving average. The upper band is a 20-period simple moving average plus a 20-period standard deviation of price multiplied by 2. The lower band is a 20-period simple moving average minus a 20-period standard deviation of price multiplied by 2. Let's now look at an example of the Bollinger Bands indicator on a chart to see how the bands interact with price. You can see on the chart that the middle band is a 20-period simple moving average. You need to be mindful that if you have a 20-period SMA already loaded on your chart when the Bollinger Bands indicator is loaded, the center line on the Bollinger Bands indicator may not appear, as it will be completely covered by the SMA already on the chart. The upper band is plus 2 standard deviations away from the middle line, and the lower band is minus 2 standard deviations away from the middle line. You'll notice on the chart that most of the price action is contained within the upper and lower bands, and even when price does cross above or below them, it generally retreats back into the band's confinement relatively quickly. Let's now look at some different standard deviations that can be applied to Bollinger Bands. The example that we can see on the screen is a Bollinger Band set at 1.5 standard deviations. You can see that although most of the price action is contained within the bands, when it does make an exit on a sharp move, it doesn't rebound back inside the bands aggressively. Tightening the standard deviation bands to 1.5 is only recommended if you are trading a low volatility market, where price is struggling to reach the bounds of the 2 standard deviation bands. If price is spending too much time outside or near the bands, then they may be a little too tight. It is important to remember that the Bollinger Bands indicator will be providing signals when price is trading around the extreme zones, so if the bands are too tight, you may end up with a higher number of false signals. The chart that we can now see on the screen has the most popular 2 standard deviations set on the Bollinger Bands indicator. As you can see in the example on the chart, nearly all the price action is contained within the bands, and when price does occasionally break through, the retracements back inside are quick and sharp. It is easy to see why this is the most popular setting, and is the one that adapts itself to the widest amount of trading instruments and timeframes without needing further fine-tuning. The chart that we can now see on the screen shows what the Bollinger Bands indicator looks like when the standard deviation is set to 2.5. The example illustrates that apart from 2 or 3 candles exceeding the boundaries, almost all the price action remained inside the bands. In fact, price only gets close to touching the bands when the trend changes and moves aggressively in one direction or another. This setting is ideal for very volatile instruments, such as exotic currency pairs and some commodities, as otherwise price would simply not get close enough to the bands to make them useful to a trader. However, when this setting is used and price does push through the boundaries, you will generally get a very strong correction back in, which makes them good zones to potentially take profit if the market pushes out to the upper bands for a long position and the lower bands for a short position. As I mentioned earlier in the section, the Bollinger Bands indicator measures volatility, and the bands expand and contract as the volatility increases and decreases. You can see in the example that as price starts to decrease in its range of motion, the upper and lower bands come in and get closer to the middle line. When price starts to move aggressively in a direction, the bands expand accordingly until volatility decreases and the market settles down. You will notice that even when the market begins to trend in a direction, most of the price action is still contained inside the bands. In an uptrend, the price pushes up to the upper band and retraces down to the center line rather than the lower line before it moves up again and continues in the trend direction, again pushing the upper band higher. In a downtrend, price pushes the lower band down, and when it does pull back, it is generally to the middle line, where it turns around and begins to push the lower band down again as it continues in the downtrend's direction. When the market is moving sideways, price bounces from the upper band to the lower band quite consistently, especially when they begin to contract. Now let's look at the trading rules for the Bollinger Bands indicator. The rules for trading Bollinger Bands are easy to follow and are market adaptive due to the inherent nature of how the indicator works. In a sideways market, you can enter long positions when price touches the bottom band, with your take profit set at around the upper band. You can then reverse your trade and take a short position aiming for the lower band for the take profit, highlighted in the yellow on the example on the screen. This style can be continued until the market starts to trend in one direction. In an uptrend, you can enter long positions when price retraces back to the middle line after touching the upper line, with your take profit set when price again touches the upper line, highlighted in the green circles on the screen. This method can continue until the uptrend weakens or reverses. And in a downtrend, you can enter short positions when price pulls back to the middle line after touching the lower band, and your take profit is set when price again touches the lower band, highlighted in the red circles on the screen. Again, this method can be traded until the downtrend weakens or is reversed. Another way that you can trade using Bollinger Bands is by trading the extreme moves. When price pushes up hard through an upper band, or shorts sharply through a lower band, it generally retraces back into the bands quickly, which provides trading opportunities if you see it. As you can see in the example on the screen, price pushed through the upper boundary and didn't close outside the upper boundary. When price comes back inside, you can place a trade in the short direction with a take profit set at the middle or lower line. Again, you can see in the middle of the chart an extreme breakout. You can trade this long when price comes back inside the bands and aim for the middle or upper bands as a take profit level. On the right of the chart, you can see another extreme breach of an upper zone, where price quickly retraced back inside the bands. This provided an opportunity to take a short position, with a take profit set at the middle or lower band. We do not advise that you use this method in markets that are trending, as any trade you reverse out of a price push outside the band in the direction of the trend will be trading against the prevailing trend. However, this method can work better in sideways markets with low to medium volatility. Let's now look at trading Bollinger Bands divergence. Divergence occurs in the Bollinger Bands indicator in much the same way it does with MACD, and you can apply the same rules on how to trade it, with one notable difference. Because price is usually pushing the bands at peaks, you can incorporate the MACD indicator discussed earlier to identify the signals. This is because by design, price and the Bollinger Bands are not going to deviate away from each other when volatility increases, and volatility is required for a reasonable market move. With this style of divergence, you are using 3 confirmation tools instead of 2. Firstly, you're on the lookout for any divergence between the MACD indicator and the upper bands for bearish divergence, and the MACD indicator and the lower bands for bullish divergence. The other filter is price itself. As discussed earlier, when price is pushing through the upper or lower bands, it generally retraces back inside fairly quickly, as it is an extreme zone. If a situation occurs where there is divergence present between the Bollinger Bands and MACD, if price is pushing outside the band where the divergence is present, it acts as another filter, or evidence of an impending reversal, making the signal even stronger. The example that we can see on the screen shows a situation where price has made a higher high and the MACD has failed to follow, making a lower high at around the same area. You will recall that this is considered Class A bearish divergence. Notice that price has pushed through the upper boundary of the Bollinger Band and retraced back inside at the highest peak. Over in the middle of the chart, price has made a new lower trough, and the MACD has failed to follow, making a higher low at around the same area. This can be labelled Class A bullish divergence, and again, price has penetrated the lower band at the lowest trough. Notice how explosive the move in the opposite direction is on these two trades when the indicators are combined with price volatility, a required ingredient for price to push outside a Bollinger Band. On the right of the chart, price has made an equal peak, and the MACD has failed to follow, making a lower peak at around the same area. This can be labelled Class B bearish divergence. Following this rule highlights the extremes that the MACD and Bollinger Bands indicators have reached, with the added benefit of higher volatility, with price pushing through and penetrating the upper and lower bands, adding further strength to the divergence signals. In this lesson, we've learned how to interpret the different Bollinger Band deviations. We learned the rules for trading the Bollinger Bands indicator. We learned how to use the Bollinger Bands in extreme moves. And finally, we learned how to interpret and trade Bollinger Band divergence. This concludes section 5 of trading indicators. In the next module, we will look at advanced techniques that can be used to hone in on the best entry and exit points. We will revisit some of the concepts that you have learned so far in this course and show you how you can combine them to achieve optimal trading opportunities.